Ever wondered how companies dramatically change their shape, grow exponentially, or even split apart? Welcome to the dynamic world of corporate restructuring. This isn't just boardroom jargon, it's about strategic moves that redefine industries and impact your investments. Let's demystify these powerful transformations together. Corporate restructuring is the strategic process companies undertake to reorganize their legal, ownership, operational, or other structures. The primary purpose is to enhance efficiency, profitability, or adapt to changing market conditions. For you, our aspiring research analyst, understanding these moves is crucial for evaluating a company's future potential. These strategic shifts are not random. They are calculated decisions to unlock value. They can lead to significant changes in a company's competitive landscape and its stock performance. Grasping these concepts will sharpen your analytical skills and give you an edge. First, let's explore mergers. Imagine two distinct companies deciding to combine forces, forming a single, stronger entity. This isn't just a partnership, it's a complete integration, often driven by the desire for synergy. They believe that together, they can achieve more than they could individually. A classic example is the merger of ICITI Bank with ICICI Limited. This move allowed them to consolidate their diverse financial services under one unified brand. Mergers typically occur between companies with shared visions or complementary operations, aiming for increased market share and operational efficiencies. Next, we have acquisitions, often referred to as takeovers. Here, one company purchases a controlling stake or even full ownership of another. The acquiring company gains significant influence or complete control over the target company's assets and operations. This is a direct path to rapid expansion or market entry. Consider Tata Motors' acquisition of Jaguar Land Rover. Tata didn't merge. It strategically bought the iconic brands, turning around their fortunes. Acquisitions are powerful tools for gaining new technologies, expanding into new markets, or eliminating competition, demonstrating a clear shift in ownership and control. Now, let's look at demergers or spin offs. This is when a larger company decides to separate a specific business unit into a new, independent entity. The goal is often to unlock value by allowing each segment to focus on its core strengths without being constrained by the parent company's broader strategy. A prime example is Reliance Industries spinning off Jio Financial Services. This strategic move allowed both the telecom and financial services businesses to pursue their distinct growth paths. It often creates more focused management and can lead to increased shareholder value by highlighting undervalued assets. The scheme of arrangement sounds complex, but it's essentially a formal, court approved plan for corporate reorganization. This legal framework ensures that any significant changes to a company's structure are conducted transparently and fairly. It protects the interests of all stakeholders, including shareholders and creditors. This process can involve various actions, such as merging subsidiaries, altering shareholding patterns, or restructuring debt. Think of it as a meticulously planned legal roadmap. It ensures that complex corporate transformations adhere to legal standards and are equitable for everyone involved. Finally, let's discuss loan restructuring, a critical process when companies face financial distress. If a company struggles to repay its debts, it can negotiate with lenders to modify repayment terms. This might involve extending loan tenures, reducing interest rates, or converting debt into equity. While not always successful, as seen with Kingfisher Airlines, loan restructuring offers a lifeline. It aims to prevent bankruptcy, protect jobs, and maintain investor confidence by giving the company a chance to recover. Understanding this process reveals a company's financial health and resilience. How do these corporate maneuvers affect you, the shareholder? In mergers, you might receive shares in the new combined entity, potentially benefiting from long-term synergy. Acquisitions often mean shareholders of the target company receive a premium price for their shares, a welcome windfall. For demergers, you typically receive shares in the newly spun off company, gaining exposure to multiple, potentially high growth businesses. Understanding these impacts is vital for making informed investment decisions. These changes directly influence your portfolio's performance. In essence, corporate restructuring is how companies adapt, innovate, and survive in an ever changing market. Whether it's a merger for synergy, an acquisition for expansion, a demerger for focus, or debt restructuring for survival, each move is a strategic chess play. These actions are designed to optimize operations and maximize shareholder value. By grasping these concepts, you're not just learning definitions, you're gaining insight into the strategic minds behind corporate giants. You'll be better equipped to analyze market news and predict potential impacts on stock prices. This knowledge empowers you as a savvy investor and analyst. Now that you've gained a foundational understanding of corporate restructuring, it's time to apply this knowledge. Start by researching recent mergers or demergers in the news and analyze their potential impact. Don't just read the headlines. Understand the why behind these strategic decisions. Like this video, share it with fellow aspiring analysts, and subscribe to our channel for more in-depth insights from the Research Analyst series. Your journey to becoming a sharp, informed analyst starts here. Let's keep learning and growing together.